Hi everyone, how are you? It's Leah Koss with the Mortgage Center, and I wanted to go through a little bit of a math-intensive equation for you because I get asked very often when I do a pre-approval for somebody over the phone or when the banks are looking at my application, what is the actual hard math that they are using to say yes or no, or how is it that they're qualifying me for a certain amount, and what can I do to make it better? So that's what I'm going to take you through. I'm going to take you through the total debt service ratio, the TDS calculation that banks use. There is also GDS, but the go-to one 90% of the time is used is the TDS. Now, what is TDS and when is it actually used? Anytime you want to qualify for a mortgage or loan, they're going to use it. And what it does is it determines how much money a bank will loan you based on your current income, other debts and payments that you have, and your credit rating. So let's go through a couple of these things. With income, it's important to note it's not just how much you make, it's how do you make your money. Salary, commission, self-employed, part-time, full-time, hourly. Well, how is it that you make the income? That's going to determine how we qualify your income. And if you want to know how, based on those different categories, how you qualify your income, go to my website, leahkoss.ca, and there's income videos on there for you. But if you want to know just on average what you make or some numbers to work with right away so that you can do this calculation on your own, use the last 2 years of your income taxes. If, however, there's a decline in your income taxes, then use the lowest of the two. It's also important to note that upcoming promotions or bonuses or anything like that, the banks do not care about. They care about the hard facts, which is the history of your earning. The only exception to this is if you make straight salary, no bonuses, no commissions, nothing variable in the amount that you make, and you're being promoted within the same company and you can get a letter from your employer saying so, there might be an exception. But on average, they really don't care about anything that's happening in the future. When it comes to debts, it's important to know what debts are important. And the ones that I'm going to be asking you about on the phone when I do an over-the-phone pre-approval is, do you have any car loans? Do you have any credit cards, line of credit, alimony, child support, other mortgages, and how much do you have owing on all of those things? The way to determine whether it's a payment that I care about is there what kind of importance is it basically that you make these payments or else? Items that don't count are things like car insurance, cell phones, memberships, things of that nature, because at the end of the day, you can cancel those if you need to. And how we would determine from the bank standpoint, what is your minimum down payment for these debts? We're going to go with 3%. So if you owe $10,000 on a credit card, we're going to say that you owe $300 a month in payments for that debt. The only exception to this is if you say have a line of credit and you can prove to us with a piece of paper from the lender that it's interest only, then we'll go with that. Otherwise, the go-to is 3%. Now, like with any loan, even if you loaned your own money out, the main question you have is, will I get my money back? So that's why we do this calculation. What TDS essentially is the percent of income that the banks will allow you to use to pay off any mandatory debt. And typically they'll allow you to use 40 to 40% of your yearly income to pay for these debts. And how do they determine whether it's 40% or 42% or 44 or 46? It's determined by the strength of your credit score. So that's why it's really important that you keep that in line. And again, if you have questions about credit, go to my website, and that's going to give you all different information about how to get credit as well as maintain your credit. Now, what is the actual equation? Well, you've got your TDS, which is a percentage, we'll say 42%, and that's going to equal your principal plus interest, which is your mortgage payment, the property taxes on the property, heat, because that's something that the banks mandate, and any other debts and payments, and we'll divide that by the gross income. What we want to find in this equation is the principal and interest, and we know all other numbers. The only numbers we don't know would be something like strata if you're looking to buy a strata unit, but we can estimate what that will be. As well, we can assume what the property taxes are by asking what city are you looking to live in, as well as is it a detached house or is it a condo, is it a townhouse, and we can estimate it pretty close. So the equation. Once the principal and interest is found using it, we can determine your maximum mortgage amount. So let's go through an actual hard example. Husband and wife together combined, they make $75,000 a year. They have a car payment, credit card payment, and a line of credit payment. They want to buy a detached house in Surrey, so we're going to estimate that the property taxes are $2,500, but they get to minus $570 of that because it's a government rebate. And this only applies if the home is going to be owner occupied, which we're going to assume that it is. We will also assume that they have good credit scores, and therefore we're going to use a 44% TDS. So let's work through these actual numbers. 44% TDS, we're looking to find the principal and interest, but we're going to use $85 for heat. That's just the go-to number. It's used in every equation. For the car, we've got that payment in there, the credit card, the line of credit. Property taxes, we found the monthly payment by simply going $2,500 of yearly taxes minus the government rebate divided by 12 gives us $161. Then we're going to divide that by the monthly income, which again is $75,000 divided by 12 to give us $62,500. So what they're essentially saying is $62,500. We're going to take 44% of that, and now we're left with $2,750. It's this amount that they will allow you to use to spend on monthly mandated payments. So we know that we already have some payments. We need to eliminate that from the $2,750. So $2,750 minus $161 for the taxes, $85 for the heat, the line of credit, the credit card, and the car payment. That leaves us with just $1,654 that they can spend on principal and interest every month for their mortgage. So what does that mean? Now this next bit of the equation is something where unless you have a mortgage calculator or you're really smart, smarter than me, then you can do the longhand version. But what I'm going to do is basically input the different criteria, and it's going to spit out how much they will qualify for. So we know what the payment is. We can enter today's interest rate, which for this example I'm going to say is 4.5%. They're going to make monthly payments as opposed to say semi-annually or yearly or something. The amortization, I'm going to give you both examples of 25-year and 35-year. And for this example, to keep it simple, I just want to keep out CMHC and Genworth fees. That's your mortgage insurance fees. So we're going to keep it nice and simple. So what I get is with a 25-year amortization, this particular family can afford a $299,000 mortgage, add the minimum down payment of 5% or 10% or 20%, and that's going to give them their maximum purchase amount. On a 35-year amortization, they can afford about $50,000 more. So again, add the down payment to that, and that's how much this family can afford. Now the thing I really want to note is that this family, they make a good living, $75,000 a year. You'd think they could afford more. But it's not about how much money you make. It's about how much money you make in respect to the debts that you already have. So if I were to coach this family, I'd probably tell them, hey, let's try and pay off that credit card first and get rid of that $300 a month credit card payment. That means now you can afford $1,954 for a payment instead of $1,654. And now, on a 25-year amortization, they can afford $54,000 more in a mortgage amount. On a 35-year, they can afford $64,000 more a year. So what that's saying is if you're looking at homes that are $300,000 and that's all you can qualify for, just by paying off your credit card, now you can afford a $364,000 home. That's a huge difference in the number of homes that you'll have to choose from, as well as the quality of homes that you're going to find. So it's important to note, it's not about how much you make, it's about how much you make compared to your debts. And this is where having a good broker to coach you and show you the different scenarios of your debt servicing ratio, how it is that we can get you into the home of your dreams that's going to make you happy. So that's all I have for you today. If you have any questions, feel welcome to go to my website, leahcost.ca, and fill out an application, and we can get going right away. That's for any of you who are renewing, wanting to refinance so you can pull money out from your home, or if you're looking to purchase a home. As well, if you want to get pre-approved over the phone today, give me a call. It only takes me, although it looks like a long equation, it only really takes me about 5 to 10 minutes to do. All I need is the numbers from you in order to do it. So give me a call 7 days a week from 9 a.m. to 9 p.m. I am available. If you have any other questions, of course, as always, give me a call. But other than that, I wish you a lot of luck, and I hope that you find the home of your dreams.